Decisions based on accounting considerations can destroy company value. In this video, I will show you why you need to understand the basics of accounting in order to be successful in your career. Hi everyone, my name is Heinrich and welcome to another episode of Firm Learning. Thank you very much for watching. If you haven't yet, please subscribe to the channel below and press the like button if you take any value out of this video at all. Accounting is something that many people consider boring, and I've seen even many business students not taking a large interest into accounting or even completing a business studies degree or a business administration degree and not really having understood the basics of accounting, even though they had some kind of lectures in it. In my opinion, this is a problem, and from my experience of having worked several years in a large strategy consulting firm, I can assure you that it is absolutely necessary for your career that you know the basics of accounting. And the reason is that in business, on a managerial level, many decisions need to be made in which accounting plays a role. Managers actually take decisions due to accounting considerations, and this can often lead to decisions that actually destroy company value just for the reason that it might positively affect some accounting figures. So in order to take part in these discussions, you need to understand these accounting considerations so that you understand your colleagues if they want to go a certain path, which might not be driven by financial value, but might be driven by an accounting consideration. And this is not to say that these people make these decisions because they are irrational or because they don't know what they are doing. They have very good reasons why they choose certain actions which might destroy firm value just due to accounting, because of course accounting matters. If a company publishes accounting figures which aren't up to the expectations, there can be some real consequences. Frequently the compensation of managers is closely tied to accounting figures, and these things are real. Companies can overvalue these things over actual financial value of the company, and it is just crucial that you understand these trade-offs in order to be considered a competent member in the management group that you are part of. In this video, I will give you two tangible examples of situations how accounting can distort managerial decision makers. These are two stylized situations that actually you see pretty frequently happening out there. These things are not just theoretical examples, but really happen all the time. I can tell you this from my experience and having worked in several industries. So it's really crucial that you understand these examples, but make no mistake, there are many other situations, many other accounting-driven reasons why companies might take a certain route which might improve certain short-term figures, but actually lead to value destruction on a financial level. So let's jump into it. So the first topic is the distinction between OPEX and CapEx. So just a preliminary remark, this video cannot serve as a full accounting primer, but I try to explain some basic concepts just as a refresher. But if you're completely new to accounting, if you did not have any training in this topic at all, please look out for some more basic resources. This video will assume that you at least have a basic understanding of how accounting works. So the first example of what kind of accounting considerations can actually destroy company value is the distinction between OPEX and CapEx. So OPEX and CapEx, what is this? Here I have the definition of Wikipedia. OPEX stands for operating expenditure. It's defined as an ongoing cost for running a product, business or system. So this is just a regular cost that companies have. So you can consider, for instance, personal costs here. You can consider here costs for service providers, for rent that you need to pay for the facilities that you run, for utilities, for all these kind of things, for business supplies. They're just the other costs of just running a business, of running a product. So this is considered OPEX, operating expenditure. And OPEX is often contrasted by CapEx. CapEx stands for capital expenditure, and it is defined as the cost of developing or providing non-consumable parts for the product or system. And here are some examples. This is something that you would usually consider an investment into something. So for instance, buying a machine that then you use to produce products, buying a building, buying some land that you use to build a factory. So things where you invest a certain amount of money today from which you hope that you will get returns or that you will hope that you get some useful value out of it in the future over a longer period of time. So why does this matter? How is this distinction at all relevant to managers making decisions for their companies? Let's look into how OPEX and CapEx expenditures affect the income statement and the balance statement. And for starters, in one dimension, of course, they're completely the same in the sense that you need to pay now, right? From a cash flow perspective, it does not make any difference if you have an OPEX expenditure or a CapEx expenditure, right? So if you pay for CapEx or for OPEX, you need to pay now. So this doesn't have to do anything here. This is the same for both. But there are differences when it comes to the income statement and the balance sheet. And now let's look at the two. OPEX, operating expenditure, directly goes into the income statement, into the profit and loss statement. So if you spend a certain amount of money, for instance, for your personnel, for your employees, then you report that as an expense in your income statement in the exact year that the expense has occurred. And the implication of that is that if you pay now, for instance, €100 or $100 to pay your personnel or to buy office equipment or other expenditures which are considered OPEX, then the profit, here the earnings before tax, or then the net profit in the very end that you will need to report, will be reduced by the exact amount of the expenditure that you had. So OPEX is directly affecting your income statement, your P&L. If you spend $1 in OPEX, your profit is directly in that same year reduced by the same dollar. And this is why managers often do not like OPEX, because it directly reduces their net profit. It directly has a negative impact on the P&L, right? So let's now contrast that with CapEx, with an expense that you can book as capital expenditure. So again, from a cash flow perspective, that's the same. You need to pay directly right now. The money leaves your bank account. But the difference is that it does not directly go through your income statement, because it first gets into your balance sheet. So let's imagine now for €100 or €100 million or whatever the amount might be, you buy a machine. Now in your assets on the balance sheet, there will be a machine appearing with the book value of €100 million or dollar. But it does not directly go to the income statement. So you do not have to directly book an expense of 100 million in your income statement. So what happens instead? If you incur a CapEx expense, there is a depreciation schedule. So there's decided that each year, over a certain defined amount of years, a certain portion of the CapEx expense that you incurred will go to the income statement as depreciation. So if you have now this machine worth 100 million, there might be maybe a 20-year or a 50-year depreciation period. So if now you have a 20-year depreciation period, this means that each year for 20 years, you will pay €5 million or dollar as depreciation in your income statement. So instead of taking the direct hit of 100 right now in this year, you suddenly only need to show 5 as a depreciation in this year. And of course, this has a much better, much more favorable net profit effect, especially in the short term. So what happens the next? Then of course the asset in the next year gets reduced by the depreciation. So if you depreciate it by 5 million, then instead of 100 on your balance sheet, it will only show 5 next year, and so on and so forth. So again, what does this mean for managers? And the truth is that even though of course there are accounting rules which prevent you to freely choosing from whether you book something as OPEX or CapEx, in reality you often have some degrees of freedom whether you book something as OPEX or CapEx. So here you could be in a situation where you decide how you book something. Or maybe you have to choose between two projects, and in the one project you can book an expense as OPEX, and in the other project you can book as an expense as CapEx. So let's look now over a longer period of time how the decision whether you have an OPEX or a CapEx expenditure actually affects your income statement. So the first option is OPEX. Let's imagine now a company that earns for a period of 10 years revenues of 50, and in order to earn these revenues of 50, they need to incur an OPEX expense of 100. And let's imagine, just for the sake of the argument, that there are no other expenses in this company. So this would lead to the situation that in the first year you would show a profit of minus 50, and then in the next years you would show a profit of plus 50, because the OPEX directly gets P&L effective in the very first year where it actually incurs, and then you do not need to book it again in the next years after. So if you sum this up, you get to a situation where after 10 years you will have made revenues of 500, so 10 times 50. You will have OPEX expenses of 100 and therefore a total profit of 400. So let's contrast that with the scenario where you have a very similar situation, but instead of booking the same expense as OPEX, you're actually able to book it as CapEx. And now the situation looks a bit different in the sense that in the first year, if you assume that the CapEx gets depreciated over the full 10-year lifespan of this project or this company, you only need to pay 10 every year. It's 100 divided by 10, so the result is 10. And the result now is that at the same revenues, depreciation 10, in the very first year, instead of needing to show a profit of minus 50, you can now show a profit of plus 40. But then of course the downside is that in the next years you have the same depreciation amount, so you only show the 40 as a profit. And as you can imagine, many managers will highly benefit the situation of the CapEx investment over the situation of the OPEX investment, because they do not want to show a loss of 50 in the first year. And there's many also empirical studies that investors dislike lots of uncertainty what the earnings of a company are. So it's often considered favorably if you can smoothen out the earnings over time compared to having a situation where you have high jumps and suddenly being significantly negative in the earnings of a company. Of course, a second effect is that the compensation of managers is often tied to the earnings, and you can imagine that the personal compensation of a manager now is significantly better if the company shows a profit of 40 compared to minus 50. And people tend to discount the future in favor of the short term, maybe also because this person only plans to stay at the company for a certain amount of years, which is why CapEx investments often gets favored. And of course, if you add all of this up over the 10-year time period, you see that the revenues are exactly the same, the expenses are in the long run exactly the same, not only that it's booked as depreciation instead of OPEX, and the profit is exactly the same. But you will see that managers favor the CapEx investment for the OPEX expenditure for these reasons. So why can this destroy financial value for the company? Well, imagine that now you would have a project with the payout profile of this option 1 in front of you as a manager, and you would be able to earn revenues of in total 500 over a 10-year period by investing once OPEX 100. Of course, from a financial value perspective, it would be beneficial for the company to undergo this investment project. But now if you would be strongly incentivized as a manager for the short term, or maybe you are in a bit of a tough financial situation with the company, you are under financial distress, you may be in a restructuring process and have committed to certain profit numbers to your external stakeholders and to investors, you might decide to not do this option 1, even though it would make financial sense for the company due to the short-term negative effects in your books, in your accounting statements that this project might have. So now let's look into a second type of examples and a second type of situations that I've seen many times occur, especially in a retail context, but other industries as well. And this is the effect of which depreciation schedule exactly you have on your inventory, on your assets, and how that depreciation schedule might affect your decision to sell or not to sell certain products in the future. So let's think about the following scenario. You are a buyer of a retail company, let's say you are a fashion, an apparel company, and you go out there and you buy 50 units of certain merchandise. And you know that you can sell the units in this year at a retail price of €5 per unit. You know that this is the fair market price of these pieces. And now you're able to buy these at a value of 2. So sounds like a good deal, right? You can sell it at 5 and buy it at 2. So now what does the balance sheet at the beginning of this year look like? You have an inventory of 100 in the balance sheet because you bought 50 units at a book value at a purchase price of 2. So let's just assume for simplicity that purchase price equals the book value. And now you go out there in the marketplace and you start now to sell these things. And in the first year you achieve to sell 20 units of the 50 units that you initially purchased. And this for an apparel, for a retail company is nothing too unusual, so you often buy a certain amount of stock and then of course you try to sell as much as possible, as fast as possible, but after the season of course often you have some stocks left over that then you need to sell again in the next season. And because you know that you get a retail value of 5 per unit, these 20 units now in your income statement lead to a revenue of 100. Now, if you look into the costs that now go into the income statement for these 100 revenues that you made, this is the cost of goods sold. This is now a cost of 40. Why 40? Because here now you need to look at the book value, right? You sell 20 units. These units are in your book at a purchase price of 2, so book value of 2 per unit. So 2 times 20 is 40. So you need to book costs of goods sold of 40 euro. And this then would lead to a profit of 60, so 100 minus 40. So what is now the situation in year 2? Now you have 30 units left in stock because you already sold 20 of the 50 units that you initially have. And now, of course, the retail value of these units decreased. Because usually the longer you wait and the older your merchandise is, the price that you actually get for the merchandise is smaller and smaller. And again, if you think about a fashion company, this is very much true. In the next season, you will usually only be able to sell the pieces of last season at a significant discount. So let's now imagine for this calculatory example that instead of getting 5, you can only get 3. Now let's look into the inventory. And here now it gets interesting. Because in this example now the company decided to not depreciate the inventory that they have. Right? So they still decide to keep a book value of 2 per unit on the inventory. And why would they do that? Well, if they do decide to depreciate the inventory that they have, then they would need to show a depreciation expense here in the last year in the income statement, in the same height that they actually depreciate the inventory that's left over. And of course, for the reasons that we've seen in the last example, the company usually has an incentive to depreciate as slowly as possible, because the faster you depreciate, the quicker the expenses show up in your income statement. And as said, you usually want to delay the expenses to hit your income statement as long as possible in order to show a positive result for your company that is as high as possible. And again, companies usually have some degrees of discretion, some degrees of freedom to what extent they depreciate the merchandise. And here now in this, of course, a bit extreme example, now we would be in a situation where they do not depreciate at all and you would still keep the merchandise, this 30 units of stock at a book value of 2 with the inventory of 60. So because now it's already the next season, you cannot sell as much of it as in the last season, because usually now you will already have new merchandise in, which you of course try to sell with a focus, but you still manage now to sell 10 units of this old lot of inventory. So 10 units at a retail value of 3 leads to revenues of 30. And for these 10 units now you need to book 20 euro of cost of goods sold, because they're still in your books at 2 euro per unit. So 10 times 2 is 20, and now you would at least still show a profit of 10. So let's now look into the next year. Now you still have 20 units left in stock, and the retail value of these 20 units though now keeps of course decreasing every year and now is only at 2 euro. Now what does the inventory look like? You still did not take any depreciation expense because you tried to delay that as much as possible, and now your 20 units that you still have lead to an inventory of 40 euro because they're still booked at 2 euro per unit. And if you now again manage to sell 10 units of the stock, you have now revenues of 20, because 10 times 2 But now you also need to book cost of goods sold of 2. And this then leads to a profit of 0. And now, of course, the whole situation doesn't seem that positive anymore. And you seem to ask, why do I even keep bothering selling this if it doesn't give me any profit? And now, of course, where it really gets unpleasant is now if you think this 1 year further, you still have the 10 units left. They are now only at a retail value of 1, so you can only get €1 for it because it's now really old merchandise. Probably it already looks a bit old and not as fresh anymore, and you will only be able to sell it as a significant discount. But unfortunately, you still have these 10 pieces in your books at a value of 2 because you just did not want to depreciate it, because then you would have taken these hits in your P&L, in your income statement much earlier. And if you now even would have the opportunity to sell these 10 units at the retail value, then you would have to book revenues of 10, but your cost of goods sold would still be 20, and then you would report a loss for the sale of 10. And this is now where managerial decisions really can come into play. And this will be a situation where some companies will prefer to not sell this inventory at all. They will prefer to just keep it somewhere in your stock, to let it rot away, but not sell it, because if you sell it, you would report a loss of 10, and you do not want a negative result in your income statement, because the company might already be stretched, because the company might already fear that they do not reach the yearly targets. So they rather don't take the sale at all, instead of needing to take the hit of taking a negative loss of 10. And this happens. Believe me, I've seen things like that very, very frequently in the corporate world. People do not want negative results on the income statement, and they would rather decide to just let it rot instead of taking the loss of 10. And of course, this is now a situation where you really destroy company value, because even though, of course, you would report a loss of 10 in your income statement, you would at least still get the money. You would at least still be able to get your €10 for that merchandise. But if you do not sell it and let it just stay in your stock pretty much forever, then the situation is that you will never sell this. And of course, if you now wait even longer, if you wait even more years, then at some point you will not be able to sell it at all, or maybe not at a value of €1 per unit, maybe only at 10 cents per unit. So you would have the opportunity to now get €10 for it, but you do not sell it because you do not want the income statement loss, even though your company would be better off, your company's financial value would increase if you sell it. So this is managerial decision making driven by accounting that really leads to a destruction of company value or firm value. And this happens. Things like that happen frequently in the corporate world. And if you do not understand these accounting considerations, you cannot take part in these managerial discussions. So these were the two examples that I wanted to show you. And the reason, again, why I'm showing you this is because I want to stress how important it is that you have at least a basic understanding of these kind of accounting considerations. Even with business graduates, I often get the feeling that many believe that as a manager, they will make the important decisions, they will think about what's best for the company, and then there are some bookkeepers somewhere to just take care of the books and will just make sure that somehow all of this gets translated in the correct way. But I can tell you this is a clear misconception. On the C-level in large blue chip companies, you can be sure that the senior leaders of these companies have a very good understanding of what the accounting implications are of the decisions that they take. And these things are very much top of mind for these companies. And if you just enter a discussion, just ignoring these accounting implementations, you will look like a fool. You will look like you do not understand what matters to these C-level executives. So make sure that you get some accounting basics. In my university studies, there was one book which I found really useful in learning exactly these basics of accounting. I left a link to the book below in the description. To be fair, it's a bit expensive, but I can tell you it's really worth it. I bought it myself when I was a student. So if you would like a basic primer into how accounting works, it's really easy to understand. It goes into some level of detail. And I promise you that your level of understanding will be much higher than that of most of people. And it's also written in a fairly easily to understand language. So even if you so far did not have much exposure of accounting, this will help you. So thank you again for watching. I hope you took some value out of this video. If you did, please press the like button and subscribe to the channel to see more videos like that. I will at least post one video every week. Please also press the notification bell to keep notifications whenever I bring out a new channel. Thank you for watching. I'm Heinrich from Firm Learning.